It has been a fall of volatility in the stock market, but as the election approaches, things are starting to change. Today, we have Don Kaufman, the co-founder of TheoTrade, here with us today to talk about this season of volatility and what you can do to protect your investments and maybe benefit during this season. We're going to give those tips coming up in just a minute. But first, let's talk about where we are in the market right now as far as volatility. How does this compare to where we've been before?
Yeah, one of the surprising aspects right now about volatility is it's relatively high given the fact that the marketplace, the market being S&P 500, is at or near all-time highs. So, even markets are sitting, sky high levels. Volatility is still relatively high, and that's relative to where it has been over the last few years. And for those of you not necessarily familiar with volatility, we can reference VIX. I mean, VIX, I'm very comfortable talking about VIX, and in and around that 20 region is, 20 years ago was average, but now that's relatively high volatility in today's marketplace.
Yeah, we saw VIX really spike earlier this year. Has it come down some since then?
Yeah, actually, there's a really interesting phenomenon going on, well, right here, right now, in front of us with volatility. Although it's still high, it's actually come down quite considerably just in the last week to 10 trading sessions, and it has to do with some of the election risk starting to finally abate to some degree.
Yeah, what exactly do the markets say about this election?
Well, there's actually quite a bit they say. I mean, there's a few aspects I would look at. One of them is obviously volatility. So volatility coming down just says, all right, the nature of the election has less uncertainty because as volatility comes down, markets are just, a little bit more certain about who and what the outcome could actually be. Now, to get really specific in terms of like what the market is saying, I would look a lot at the US dollar. And the US dollar over the last 3 weeks is exploding to the upside. I mean, there's been like one down day, some phenomenal moves right now, though, inside of that dollar market.
So, along with the American dollar going up, there's another field, and that's gold. That's really getting new highs right now.
What's incredible about that is it's a little bit of a catch-22. Usually, when you see the dollar going up, that's actually going to hurt some of the commodities because they're priced in dollars. Gold, to me, its rally right now. It's unfortunately one of the scariest trades that I'm seeing. It's inflationary. There's just no question because the US dollar going up as dramatically as it is, it should put pressure into gold, meaning gold actually seeing some sell side activity. On the contrary, we're actually seeing gold rally with that. Now there's constant, the drumbeat of the U.S. debt and the interest on that debt is getting louder and louder, and we're seeing gold rally with it. Frankly, look, the situation might not necessarily be coming to a head like tomorrow or a week from now, but the debt situation in the United States, the situation is actually coming to a head, and it's evidence there's going to have to be something done about it. But what is gold going to hit 3,000 before anybody starts to listen? Quite plausibly.
It's so interesting to see the dollar and gold going up at the same
It is.
time. Very interesting combination. Let's talk about another area. You're talking about debt, but interest rates in general. We saw the first Fed rate cut in years. What has the market done since then?
It's ironic that you mentioned that as well because it also relates back to the election. If you listen to some of the election, the campaigns are like, and interest rates are going down. On the contrary, interest rates, specifically the 5-year, the 10-year, the 30-year, have actually soared higher since the Fed has cut. I'll give you specifics in here. So if we were to look at the 10-year, that's the 10-year, obviously Treasury, and the interest rate associated with it. A few weeks back, right when the Fed was cutting by 50 basis points, right? The interest rate was actually in the 10-year was sitting right around 3.6%. Today, it's actually over 4.1%. So most of your mortgages, even though you have a 30-year mortgage, even a 15-year mortgage, those are actually based off the 10-year, and the rates are actually soaring on them, uncomfortably so, the speed to which it's going up. And, we haven't seen too dramatic of an impact to home builders yet, but that's actually a trade opportunity that could be there where, the home builders could start to actually come down. But so you've got asset classes that don't typically trade in these correlations. We're all over the place right now. Gold's up, the dollar's up, interest rates are up, S&Ps are almost at all-time highs, an election's coming up. It's not the most comfortable marketplace. It's probably one of the reasons volatility has been higher. It's just not one of the more comfortable marketplaces that I've been in the last, 25 plus years.
All of the things you just mentioned are why a lot of investors are looking for some guidance. How do you manage your own portfolios, your own investments in the middle of this uncertainty?
So in two very definitive sides of me. So I have an investment side, and then I've got a little bit more of the trader side. The
Mhm.
trader in me, if I'm going to get bullish or bearish, I'm going to use spreads. I'm going to use spreads because I want to mitigate the total exposure. A spread basically says like, look, if I go out and take a trade inside of Apple, I know exactly what my risk is going to be. It's $1.50 getting in here, or it's $1 getting in there. I know exactly what that's going to be. So I'm going to take measured, just pokes at the marketplace, looking, okay, for specific upside opportunities and or downside opportunities. Now, that would be the trader in me. The investor, look, investment right now with S&Ps at all-time highs makes me nervous, but the S&Ps have been continuously hitting all-time highs. I am really, okay, avidly into what we term long short. Okay, there are areas that, for instance, I own, a few of the tech companies right now, but I'm also heavily short, for example, the financials. There's nothing wrong with creating short positions. When I say short, that means in the financials, I use the XLF, and I may actually substantiate a position, okay, where I'm actually short shares, or, okay, using a deep in the money option to simulate a short share. It's what we call a synthetic. That would be for somebody like that traded inside of an IRA. But in no uncertain terms, like I'm just not comfortable in these markets. Just saying like, okay, I'm going to buy the S&P 500 and buy and pray is not going to be a good strategy for the foreseeable future. And we've actually heard some of the largest banking institutions in the world just in the last 24 hours talk specifically about that future returns for like the next decade are going to be largely mitigated due to higher volatility, higher interest rates, okay, debt issues. This is going to be a challenging time. This is going to be a time where you're going to have to learn more than just throw money at the market and pray. That's unfortunate, but that's what firms like TheoTrade do is we educate specifically around those logics.
Absolutely. I think we've heard that from our analysts here too at MarketBeat that this is just the start of volatility. A lot of people in the market, a lot of analysts are expecting this volatility to continue. And no, volatility means you can't predict it, right? Anything could happen, and that's why we're in this uncertainty. But if you were to give traders some advice here on the next 2 weeks, we've got an election coming up. When do you see the markets reacting most? When do you see the most volatile moves in the market surrounding the election?
Ironically, is I don't think we're going to hold out till the election. I think we're, days, maybe even hours away from larger bursts of volatility coming out, and that's specifically, again, once the markets have kind of subsided, like that election risk, that fear starts to go away. Like, look, there's a lot of areas that are going to get wild and wild in a hurry. Tech being one of them. I mean, look, there's, situations where tech may actually be in trouble in the very near term with a Republican nominee and going back into the White House. So that unto itself could actually create degrees of volatility. Moreover, I mean, look, we have an explosive dollar right now that is going to be exporting inflation in a big way. So whether you believe what Republicans coming in there or not, push that aside for a second. The dollar rallying is exporting inflation. So what the Fed is also going to do right after the election is going to be fairly critical, and they very well may not actually cut interest rates. Like that inflation, again, that drumbeat is also getting louder in this marketplace where inflation could come raging back in here, and the markets could actually, again, come to the assumption, look, if Republicans are actually nominated, that clearly means inflation's actually coming back. Let's actually see some sell side activity to markets. But either way you want to put this is not going to go quietly off into the night.
After the election, like you mentioned, we do have a Fed rate cut still, or a Fed rate decision coming up after that too. So there's more factors than just the election. But do you see the volatility coming down at any point post-election, and when might that happen, if so?
On the contrary, I think we're actually seeing the lull in volatility right now. So we had a bit of a volatility spike. The last few trading sessions have backed off. As we start to come closer to the election, though, I think it may take back off to the upside. And after the in a post-election marketplace, I think we're going to see considerably more volatility. Look, there's going to be a whole lot of chaos coming into this marketplace. The uncertainty, okay, of a nominee, or even better than that, maybe we don't have clear results for 2 to 3 weeks after the election, which is, even if we think we know who's going to win this, okay, clear and concise results, okay, are anything but a certainty, especially in today's day and age. So that unto itself, I mean, everything that you want to look at, like the deck is kind of stacked right now to see more volatility, not only coming into the election, but thereafter.
So let's speak more to those long-term investors as we close out today. What can they do, or should they be doing something to protect their investments right now? Are there safer options they can do to try and escape some of this volatile time that we're going to have coming up in the next couple of weeks and months, especially?
There's no shame in actually reducing some of the overall exposure. The easiest hedge, and hedge is risk reduction. The easiest risk mitigation tactic is to actually pull, like, 1/3 of your capital, put it in cash for a period of time. That's the great thing about being an individual investor, is that you can do what you want, when you want, how you want. Not like a mutual fund that has to stay fully vested. Okay, you have the opportunity to mitigate some of your exposure, and with S&Ps at all-time highs, why not? I mean, what are you going to do? Oh, if we do explode to the upside, miss a little bit more, put that capital back to work a little later. But there's no problem. Okay, this business does not have to be all or none. You don't have to be all in or not. Cut your risk by 1/3, one half. Be able to at least sleep at night, because we are going to come into a bit of chaos in this marketplace right here in the near term.
Some very good advice. No shame in being a little safer right now. Thank you so much for your time today, Don. And you can find more of Don's and TheoTrade's information. We'll put a link to their website right here. Are you working on anything special coming up soon, Don?
Absolutely. Actually, we're definitely discussing volatility trading in more volatile markets. This is does look like for the foreseeable future that we're going to be in what we would term a trader's market.
Wonderful. Well, thank you again. And we've got that link right there for you. You can find more stock market news right here on MarketBeat Media. And as always, thanks for joining us and happy investing.